Hello, everyone. This video is going to cover exercise 1018B, looking at the ethical professional practice or practices. In our example, we have a CFO who is intentionally misclassifying a downstream transportation expense in the amount of $600,000 as a product cost instead of a period cost. And during that time period, they created and made 3,000 microscopes and sold 2,000 of them. And Misty, the CFO, rewards its officers with bonuses that are based on net earnings. So we need to indicate whether the elements of our financial statements are going to be overstated or understated or not effective. So let's think about our horizontal statements model or our balance sheet for transactions. So we have our assets, cash and inventory. We've got our liabilities. We've got our stockholders' equity, which then would be common stock and your retained earnings. And then if we look at our income statement, we've got our revenues and our expenses, which then equals our net income. All right, so if these are counted as a product cost, that means that we are adding it into our inventory. So what should happen with these is we should see, I'll put this in blue, this should be an expense that's right away there. So it should come out of our inventory, out of our cash, right? Go in as an expense. So then our net income would go down. However, what's happening is we put that in our inventory. So we're going to see our cash still go down, but our inventory is going to go up because it's a product cost. It went in as a product cost, which then does nothing over here. So how is that going to affect what's actually shown? Well, if we look, we've got our assets first. Instead of the cash simply coming out, the cash still comes out, so that's not a big deal. But we see our inventory increases. Because of that increase, that means that our assets are going to be overstated. So we're going to show a higher asset amount than really exists. Our liabilities, we can see from this that nothing happened to that. So our liabilities are simply not affected. When we look at retained earnings should have had something taken out of it. Instead, nothing happens. Because of that, that means that our retained earnings are also going to be overstated because they're going to be higher than they should be. My revenue, if we look, nothing happened to revenue before, nothing happened to revenue after, so our revenue is not affected. When we look at our expenses, before our expenses were positive, so we had an increase to expenses, nothing happens there. So our expenses should actually be understated. Because they should have added something into our expenses, but instead we didn't. So then finally, my net income. Before we had being subtracted because of that expense, but now because it's over here in inventory, nothing happens to it, which then means we again have an overstated net income. So before we discuss the actual amounts that are being overstated, let's think about why this might happen. If we know that our net income is overstated, well, bonuses are based on your net earnings. So if you've got net earnings that are overstated, that should mean for bigger bonuses for your officers. So now let's figure out exactly how much we overstated this. So the first thing we need to look at is we made $600,000 worth of, or we have $600,000 worth of expenses, right? that were misclassified. Well, because they were misclassified as a product cost, we know that they went into inventory. So that's going to be split amongst our entire inventory because now it's being expensed as costs of goods sold. So we have to figure out how much it is, how much of that $600,000 is misclassified per microscope. So we divide that by the total number of microscopes that we created during that time, which is 3,000. When you divide that, you should find that it is distributed as $200 per microscope. Since we've sold 200 or 2,000 of those microscopes, we then need to figure out, okay, well, we made 3,000, we sold 2,000, so what's left in inventory? We have 1,000 left in inventory. So what this is telling us is that of that $600,000 that was misclassified, how much of it is still left in inventory? Well, if we have 1,000 microscopes and we had $200 worth of that transportation cost per microscope, we find that we get $200,000 of transportation costs left in our inventory account, which then means that our assets are overstated by $200,000. Our retained earnings are overstated by $200,000. Our expenses are understated by $200,000. And our net income is overstated by $200,000. So there's a $200,000 discrepancy between the total amount of inventory coming in, so our assets, and our net income. So our net income has a $200,000 overstatement that can be used to reward officers with bonuses. So then the question for Part B says, suppose an employee who works for the CFO discovers that they deliberately engaged in this fraudulent misclassification. What action should the employee take? Well, there's a couple things. The first thing you could do, discuss the matter with the person who's one level above the CFO. So that would probably be the CEO or some actual owner, someone who's just one level above them. You could clarify relevant ethical issues by talking confidentially with the IMA ethics counselor, or you could find an impartial advisor to obtain better understandings of the possible courses of action. Or the third thing you could do is consult with your personal attorney to see what your legal obligations and rights are concerning this ethical issue. And that is exercise 1018